Joining us to talk about all of this is John Hartley. John is an economic policy analyst and writer. John, good to have you back on the show with us. John, firstly, I want to get your take on this market volatility. Do you just expect this going forward now?
Thanks for having me. In particular, I think it's important to think about what's caused this market sell-off. What are the root causes of the 5% sell-off in the equity market since last month? And I think it really comes down to largely trade concerns over a potentially worsening trade war with China. I think part of the gains toward the end of this week have a lot to do with President Trump delaying the 25% tariffs on $200 billion of Chinese goods. Those originally supposed to take place on September 1st, and it's been delayed to December 15th. And what you also saw this week was an inversion of the yield curve, which means that longer-term Treasury yields have fallen below short-term ones. I think there's a lot of confusion over what that means. All past post-war recessions have actually been preceded by yield curve inversions, but not all yield curve inversions have necessarily been followed by recessions. In particular, a yield curve inversion would suggest that the Fed is in the future going to cut rates, and as the Fed just did earlier this year, they cut the federal funds rate by 25 basis points, and it's looking increasingly like they'll do so again. Right. So that seems like a rational expectation, but that at some level this is an insurance against a potential recession and not a certain one or one that's immediately apparent. So I think that in particular, I think as long as these trade concerns continue to abate, I think the market's probably overreacted to some degree, and I think you'd probably see some sort of correction continue.
All right, let's focus on the recession angle. Do you really buy the notion that we can go into a recession the next year? I mean, granted, economies are cyclical. There's always going to be a recession. This has been the longest period of economic growth in history, and one is bound to happen, that there's going to be a turn in the cycle here. But do you really see this happening as soon as next year?
Well, I think it's important to remember what have been kind of the root causes of all the post-war recessions. There's really been largely two things. One, it's either been a Fed policy mistake where the Fed raised rates excessively high, like the Volcker Fed did in the 1980s. They raised interest rates to 19% to fight double-digit inflation, and a recession followed it. And then the other types of recessions have usually been a result of some sort of financial imbalances, like, for example, the tech bubble in the early 2000s or the housing bubble in the late 2000s. And I don't think that there's some sort of financial excesses that are immediately apparent. There seems to be some sort of frothiness in the non-financial corporate debt market, but it's not completely clear that that's a systemic threat either to the economy. A lot of people pointed to the yield curve as being a recession-type indicator, but what I would remind those people is that there's a lot of technical factors that are at play now that haven't been at play in the past. Namely, you have a $4 trillion Fed balance sheet, which has bought long-term bonds, is keeping the long end of the yield curve down, and you also have a Treasury debt structure that's issuing a lot of 3-month T-bills, which is pushing the short end of the yield curve. This is to fund the increasing debt that's being used to fund, in part, tax reform and other initiatives. But I think it's really important to remember that this time might actually be a little bit different in that the yield curve
Right.
inversion may not be the same kind of indicators of future recessions as it may have been in the past.
And of course, a lot of focus is going to be on Fed Chair Jerome Powell when he speaks at Jackson Hole next week to see if he's going to clarify the Fed policy. John, thank you so much. John Hartley, appreciate it.